Hello, everyone. My name is Adriana Calderon. I'm the Director of Transfer Pricing Solutions Asia, and today I'm going to be giving you a brief overview of the transfer pricing requirements in Singapore. Before we deep down into the topic, I would like to introduce our firm. We are a niche specialist firm that provides practical, proactive, and cost-effective transfer pricing advice. We are a group of advisors from Big Four and mid-tier firms located in Australia, Singapore, and Malaysia. I am the lead partner for our Asia business with more than 15 years of experience in advising multinational groups on how to solve their transfer pricing issues and manage their risk. So we will be touching today 5 key topics. First, what is the arm's length principle in Singapore? What is the transfer pricing environment in Singapore? 3, what are the transfer pricing requirements in Singapore? 4, what are the benefits of preparing transfer pricing documentation? And 5, what is the risk in Singapore of non-compliance? So first of all, the arm's length principle is the international standard that guides the transfer pricing requirements, which requires related parties to enter into transactions under comparable conditions and circumstances. In other words, related party transactions have to make commercial sense and reflect the arm's length pricing, which in very plain language is a market price. What is the transfer pricing environment in Singapore? In Singapore is, as we all know, a very attractive place to do business and attracts many multinational companies to set up offices in the country. Therefore, naturally, taxpayers in Singapore may have many cross-border related party transactions. For this reason, the Inland Revenue Authority of Singapore has been active in monitoring Singapore's taxpayers' compliance with the transfer pricing legislation and regulation. So what are the transfer pricing requirements in Singapore? All Singapore taxpayers engaged in related party transactions have to comply with the arm's length principle. From year of assessment 2018, taxpayers in Singapore must state in the corporate tax return whether the value of the related party transactions exceed 15 million for the relevant year of assessment. If exceed, the taxpayer has to complete the form for reporting of related party transaction, also known as RPT form, as submitted together with the tax return. The related party form serves as a risk assessment tool by IRAS and can be considered as the starting point for IRAS to select cases for transfer pricing audit. Furthermore, the Section 34F, which is the income tax, which is a section of the Income Tax Act, has made transfer pricing documentation mandatory for certain Singapore taxpayers who meet certain conditions to basically prepare and maintain contemporaneous transfer pricing documentation for each fiscal year to demonstrate compliance with the arm's length principle. Transfer pricing documentation should be contemporaneous to the related party transaction, and this means that it needs to be prepared at the latest by the time that the taxpayer filed the tax return for the financial year. If IRAS requests the transfer pricing documentation, it should be provided within 30 days that are not subject to extensions. What are the benefits of preparing transfer pricing documentation? Transfer pricing documentation reduces the risk of transfer pricing audits and dispute with IRAS. It assists to explain the taxpayer position to IRAS because if the taxpayer has prepared documentation, it gives a good indication of IRAS of proper governance and proper planning and thinking on about transfer pricing and compliance with the arm's length principle. It also minimizes penalties in the event of an audit adjustment. What are the benefits of preparing documentation? Preparation of transfer pricing documentation does not only demonstrate the taxpayer commitment in adhering to transfer pricing laws, it also provides IRAS with useful information to conduct an informed transfer pricing risk assessment and a thorough audit. What are the risks of non-compliance? There are basically a few risks, but to sum up, non-compliance with the TP documentation can give up to a penalty of up to 10,000 for each basis period of non-compliance. Non-compliance with the arm's length principle will basically result in a transfer pricing adjustment that will add a tax payable and a surcharge of 5% on the TP adjustment. Furthermore, taxpayers will not, with no transfer pricing documentation contemporaneous, are not allowed to perform year-end adjustments, basically adjustments leading to the reduction of income for taxpayers, but not allowed for tax deductions due to non-compliance, and are not allowed to request assistance from tax authority in the event of double taxation issues. So if you have any questions or you need help with your transfer pricing documentation or transfer pricing planning, master file, local file, regional documentation in Asia, global, regional, and local benchmarkings and contracts, feel free to reach out to us and follow us on our social media channels, YouTube, Twitter, Facebook, LinkedIn, and our website. We're always publishing interesting material and videos for our audience to gain and educate themselves for free. Thank you.